I made my first paycheck as a new immigrant to Canada about 10 years ago. To make my money work for me, I started investing. But for the next couple of years, my investment returns were not great. I was making some money through my investment, but I could have been making a lot more. I made several mistakes along the way. The mistakes that I made were not catastrophic and did not lead to losing a lot of money, but I did miss out on some opportunities that could have helped me build my wealth a lot faster. Today, I'm sharing 4 of those mistakes with you, so hopefully you can avoid them in your own investment journey. Before we jump in, please consider subscribing to the channel. It's totally free and a great way to support the channel, and I really appreciate it. Alright, let's dive in. My first mistake is what I call the home country bias. As a new Canadian, I was investing only in the Canadian stock market for the first couple of years. Investing in Canada was naturally easier. I didn't need to exchange my Canadian dollars to any other currency. I also assumed that the Canadian economy has to be as strong as any other first world nation. Turns out that's not the whole picture. Investment in new technologies and productivities is significantly higher in the United States compared to Canada. As a result, the United States economy tends to grow a lot faster than the Canadian economy, which shows itself also in the stock market return. If we compare the performance of S&P 500 with the TSX, we will see that the performance of S&P 500 over the past several decades has been significantly better than the TSX. Don't get me wrong, I'm not trying to say that investing in the Canadian stock market is wrong or is a mistake, but investing exclusively in the Canadian stock market was a mistake on my part. Canada's market is heavily concentrated in 3 sectors: banks, energy, and material. By only investing in the Canadian stock market, I was missing out on some great opportunities like technology and healthcare. My second mistake was not continuously learning about investment. Doing things like reading investment book, learning how to analyze different stocks, and learning about different metrics that make a great business also a great investment. When I started investing, I watched a YouTube video just like this one. It taught me about safe dividend-paying stocks like banks, telecommunications, and utility. I remember a part of that YouTube video which was a scene from the movie The Wolf of Wall Street. In that scene, Matthew McConaughey was saying that investment returns that aren't real cash are a fugazi or not real.
It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right? All right.
The point that the YouTube video was trying to make is that only dividend payouts are actual and real money. And the stock value appreciation is a fugazi and is not real, which is not true at all. When a company like Amazon doesn't pay dividend, it's because they take that money and reinvest it in the business. They know that they can provide a better return for the shareholders by reinvesting that money into the business. They take that money to build a new data center or create a new product. And that's as real as paying dividend. Dividend stocks were the perfect place for me to start, but I got comfortable. For the next couple of years, I just kept buying those very same stocks. During the next few years, I missed out on great investment opportunities like Meta, Amazon, and Google simply because I was too complacent. The lesson that I wish I knew is that learning must be a continuous part of the investment process. Reading related books, doing research, understanding important KPIs that you can look at to understand if a good business can also be a good investment. In my third investment, I turned a really good trade into a bad long-term investment. When COVID happened, airline stocks collapsed. I correctly predicted that those stocks would rebound once the restrictions are lifted. So I bought Air Canada at about $20 per share. A few months later, the stock price increased to $30 per share, about 50% gain in a short period of time. That was the trade. But I got greedy. I looked at the pre-pandemic price of the stock, which was about $50, and I anchored to that price thinking that the stock value will naturally go back to $50 per share. But it never did. It actually fell from that $30 recovery price and has been hovering around $18 to $22 for the past several years. I locked my money in a dead stock, waiting for a price that actually never came. I didn't understand that some entire industries are just terrible businesses for the long-term investment. They are capital destroyers and offer lumpy and inconsistent returns. These are industries like airlines, automakers, commodity producers like oil and gas and mining. They are highly cyclical with insane cost and capital expenditure. They face brutal competition and have very low profit margins. The lesson I wish I knew is that you must know why you own something. Is this a trade based on a price swing? If yes, you must have a clear exit price in mind. Is this a long-term investment? If yes, it better be a high-quality compounding business. My last mistake is a classic, chasing the hype. This happened to me during the massive AI hype. Everybody was talking about Nvidia, but I thought I had already missed out on the opportunity and the price seemed way too expensive. Quite honestly, I had a huge fear of missing out. So I looked at something within the AI play, but perhaps not as expensive as Nvidia. I landed on Dell because they make generative AI servers. But I didn't do any real analysis of the stock. Soon after I bought the stock, it actually fell by around 30%. It was actually a nerve-wracking experience because I hadn't done my homework and I had zero conviction. I managed to stay patient and honestly got a bit lucky. The stock gradually recovered back to my buying point. I sold the stock and collected a very tiny dividend and learned a valuable lesson. The lesson was that you must understand what you're buying, why you're buying it, or what is your investment thesis. When you buy a stock, you're actually buying a piece of a real business. Do your homework or you will be the first person to panic sell at the bottom. Although I broke even and I didn't lose any real amount of money, there was the opportunity cost. The money that was spent on Dell could have been spent on some high quality stock and could have been making money for me rather than breaking even. Despite some ups and downs, investment and stock picking has been an incredible learning journey for me. It took me from a safe dividend investor to where I am today, a long-term, global, growth-oriented investor. It taught me about many investing and actually life lessons that are with me for the rest of my life, and I'm intending to share with you through this YouTube channel. I hope these lessons help you avoid the mistakes that I made and improve your investment returns. What's the biggest investment mistake that you have made? Or what are the lessons that you wish you had learned a bit sooner? Share it in the comment section below. I read every single one of them. Thank you for watching. See you in the next one.